Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, October 5th, 2023. We'll start with our executive summary this morning. So, number one, inflation is now the top down market regime. If you're a 42 macro client, you definitely know what that means in terms of sector and style factor dispersion, anticipation, both within and across asset markets. If you're not a 42 macro subscriber, best of luck. We appreciate you for tuning in. Number two, another global economic dynamic that we've been prescient on of late, since late July, is the resounding strength in the U.S. dollar, which in DXY terms has appreciated every week since. Recall that our seminal work on global liquidity confirms dollar strength is one of a handful of market indicators that act as a drag on global liquidity. Others includes derivatives, causes, and effects of dollar strength, such as currency volatility, real interest rate shocks, and fixed income volatility. Each is up big on a month-over-month basis. And number three, both initial and continuing jobless claims continue to suggest a low probability of a near-term recession in the U.S. economy. Meanwhile, every major economy in the Eurozone has negative year-over-year real retail sales growth, and every major economy in the Eurozone except Spain has negative year-over-year industrial production growth. U.S. exceptionalism persists. Transitioning to our cross-asset performance monitor here. So we'll start with U.S. equities sectors. S&P down another 1.1% week over week, being led to the downside by energy down 7.9%, also being led to the downside by utilities at minus 4.7%, outperforming. It got tech up 0.8% week over week. So you're starting to see a little bit of a reversal of that kind of, long energy short tech trade that we've experienced this summer. In terms of factor performance, we're at minus 1.1% again on the S&P, leading to the downside. You got value down at 2.7%, whereas growth is up 0.1%. Limited dispersion between high beta and low beta. So this is really, truly a reversal of that value growth trade that we've seen throughout the summer. Geographic performance down, S&P down 1.1%. Outperforming all geographies is India, only down 0.3% week over week. In terms of what's leading to the downside here, you got Japan minus 5.3%, followed by Brazil at minus 4%. These are two of the places folks have liked in recent months. So folks are definitely booking gains and getting out of that, at least from a risk management standpoint. In terms of fixed income, that Barclays Ag down 1.1% in terms of the core ag here in the U.S. TLT down 3.1% here. And you also have just limited dispersion across some of these other factors here in the fixed income market. High yield down 1.6%, high grade down 1.8% in terms of U.S. credit. Mortgage-backed securities down 1.6%. So again, a lot of the, it's kind of a mixed bag in terms of what's driving the volatility in the fixed income space. Largely rate volatility. If you look at the movement, TLT and HYG, or not HYG, TLT, LQD, and MBB. But you also have a little bit of credit risk developing as well in terms of the move in HYG. In terms of currency performance, the dollar continues to be up. I think it's been up every week since late July, 0.6%, another week over week move in the UUP here, the US dollar ETF. Also performing positively is the Japanese yen. That's a risk-off move there in terms of minus 0 or plus 0.4%, and then leading to the downside in the currency market. Got the Canadian dollar down 2.3%, followed by the Australian dollar at minus 1.5%. And then in terms of the commodity space, so commodities are taking a bath week over week here. Obviously, we've seen a bit of a drawdown in crude oil prices. So commodities, the DBC ETF, the broad-based basket is minus 5.7% week over week. You got crude oil and uranium leading to the downside at minus 8.8% and minus 9.8% respectively. And then lastly, crypto actually posting some positive performance week over week. Bitcoin up 3.7%. The crypto being led higher by Solana, again at plus 9.4% on a week over week basis. And then lastly, transitioning to my Longbow dashboard in terms of the range, trading ranges here. So we got an oversold signal here in the crude oil. That number's, it's the low end of the range there is right around 84.22 there. So just be aware of that. Or so 85.71 is the low end of the range. So we're well below the low end of the range. So for those of you who believe in the sustainability of the crude energy move into the fall, this is definitely a phenomenal spot to be accumulating energy type assets here with positive medium-term momentum still intact. So we'll wrap it up there. Darius Dale presenting our macro minute for Thursday, October 5th, 2023. For those of you 42 macro subscribers, we got a monthly macro scouting report out next tomorrow. So be on the lookout for that. It's going to be another fantastic presentation. For those of you who do not subscribe, I definitely highly recommend checking that out. We put out a lot of research that's been very accurate since we started this firm, and a few things have been more accurate in terms of the resilient U.S. economy theme, the bifurcation that we called out in terms of, the U.S. exceptionalism, so the volatility we've seen in interest rates this year, the positive move we've seen in stocks this year, the dollar strength we've seen throughout the summertime, the decline in global liquidity that we've spotted since the springtime. A lot of these things that come out of our macro scouting report that we provide updates on a daily basis in our lead off morning note. That's the repository of all that information, that forward-looking prescient information is that macro scouting report presentation that we put out every month after the jobs report. So definitely highly recommend checking that out if you care about our research and care about me as a person. So we'll wrap it up there. Darius Dale presenting Macro Minute for Thursday, October 5th, 2023. Best of luck out there today. We'll catch you back here tomorrow.